Hey there, I'm Bev from bookkeepingcoach.net. With over 30 years in bookkeeping and finance, I've seen it all and fixed it all. Whether you're a new bookkeeper or a business owner handling your own books, I know how overwhelming it can get when there's no one to turn to with questions. That's exactly why I created this channel. No more messy books, no more sleepless nights. Just clear, practical advice from someone who's been in the trenches. So hit that subscribe button and let's transform those financial headaches into financial clarity, one entry at a time. Bookkeepingcoach.net. Your questions answered, your business empowered. Welcome back to our QuickBooks Online tutorial series. Today, we're diving into the chart of accounts, which is the backbone of your accounting system. Getting this right is absolutely essential for accurate financial reporting. Your chart of accounts might be silently sabotaging your financial reporting without you even realizing it. Today, I'll share professional structures that create crystal clear financial analysis. I'll also show you how to fix common mistakes without losing your historical data. Account types. Let's start with the 5 main account types and when to use each one. Assets represent what your business owns: your bank accounts, accounts receivable, equipment, and any other property, and these appear on your balance sheet. Liabilities cover what your business owes, like loans, credit cards, and accounts payable. These also will appear on your balance sheet. Equity accounts track the owner's stake in the business. This completes the balance sheet equation, which is assets equals liabilities plus equity. Income accounts track your revenue sources and appear on your profit and loss statement. Expenses categorize your spending and also appear on your profit and loss statement. Using the wrong account type, for example, tracking a loan as an expense, distorts your financial picture and can lead to serious reporting errors. For logical grouping strategies that enhance financial clarity, use parent-child hierarchy for summary-level accounts with detailed sub-accounts. For example, create a marketing expenses parent with social media marketing and print advertising as sub-accounts underneath it. Group your accounts based on how you make business decisions. The goal is to create reports that directly answer important business questions. While numbering systems are optional in QuickBooks Online, they become increasingly beneficial as your business grows. The standard approach is to use the 1000s for assets, 2000s for liabilities, 3000s for equity, 4000s for income, and 5000 to 10,000 for expenses. When setting up your numbering system, leave gaps for future additions. For example, use 5100 for office supplies, then skip to 5200 for your next category. This will create logical order in reports and makes account management easier as your business expands. When it comes to account depth, I recommend limiting your hierarchy to just 3 levels deep. For example, marketing as a parent, digital marketing as a sub-account, and maybe social media advertising as a further sub-account. For additional analysis, use classes, tags, location tracking, rather than creating even deeper account levels. Always ask yourself, will this detail level affect business decisions? An overly complex chart of accounts makes daily bookkeeping inefficient without adding any valuable insights. Let's talk about common chart of account mistakes and how to fix them. One frequent error is creating overly detailed accounts that create bookkeeping nightmares. For example, having separate accounts for office pens, office paper, and office staples instead of a single office supplies account makes transaction categorization tedious and error-prone, and it creates a cluttered, hard-to-read financial report. To fix this, identify overly specific accounts and consolidate them. Create a more general parent account and merge those detail accounts beneath it. Before consolidating, always export transaction reports for reference. Another common issue is using vague account names that lead to miscategorization. Problematic examples include miscellaneous expenses or other income, which don't provide useful information. Technical but unclear names like Form 941 liabilities instead of payroll tax payable can also cause confusion. Fix this by renaming accounts with clear, specific, plain language names. If needed, include the account purpose in the name, such as software subscriptions monthly, in brackets. Well-named accounts make transaction categorization faster and more accurate. Inconsistent account hierarchies can also distort your reports. For example, having some marketing channels as sub-accounts under marketing, while others exist as standalone accounts, will understate your total category expenses. To fix this, envision your ideal reporting structure, then reorganize to create a consistent hierarchy. QBO's drag and drop feature makes it easy to rearrange accounts. Focus on organizing categories that matter most for management decisions. Duplicate accounts split related transactions across multiple accounts, understanding category totals and creating confusion during categorization. Examples include having both advertising and marketing as separate accounts. To address duplicates, identify them and decide which name best represents the category. Use the Make Inactive feature after reassigning the transactions. Watch especially for duplicates across account types, such as having both an expense and a liability account for the same purpose. When to add, merge, or delete accounts. When merging duplicate accounts, follow these safe procedures. Export detailed transaction reports for all accounts being merged. Identify which account to keep, typically the one with the most accurate name or the most transactions. And then reclassify your transactions using batch update or by editing the individual transactions. Make sure you run reports to verify zero balances in the accounts you're eliminating. Make empty accounts inactive so that you maintain your audit trail and it prevents accidental transaction deletion. Make accounts inactive when they have transactions but are no longer needed. Inactive accounts are preserved for historical reporting but removed from active lists. You can always reactivate them if needed in the future. When adding new accounts, try to do so at the beginning of the fiscal year or reporting period when possible. Consider how mid-period additions might affect report comparisons, and place new accounts within your existing hierarchy at the appropriate level, and use consistent naming conventions. For refinements, consider creating sub-accounts under original accounts to preserve reporting continuity. For accounts with historical transaction, use the Move function to relocate them within the hierarchy or the Edit function to rename them. For consolidation, batch reclassify transactions before making the old account inactive. Create a mapping document showing the old structure and the new structure for reference. Consider implementing major changes at the start of a new fiscal year and annotate any mid-year changes in your accounting notes. Industry-specific recommendations. Let me share some industry-specific account recommendations. For service businesses, create separate income accounts for each major service type. Include expense accounts for subcontracted services, professional development, and licensing fees. Create a cost of sales section for expenses tied directly to service delivery. Track service delivery software separately from administrative software, and consider using classes to distinguish between billable and non-billable expenses. This helps you monitor true service cost and optimize your pricing. Retail and e-commerce businesses should have separate income accounts for each sales channel, in-store, website, Amazon, and so on. Create asset accounts aligned with your major product categories and dedicated expense accounts for shipping supplies, packaging, fulfillment. Track marketplace fees, commission costs, and online payment processing separately. Have separate accounts for returns and allowances by channel. Align your cost of goods sold categories with income channels for margin analysis. This enables detailed profitability analysis by both channel and product category. Contractors and construction companies should structure income accounts by project type or service category. Create direct cost categories aligned with your estimating process. Set up dedicated liability accounts for customer deposits and progress billing, and have specific asset accounts for different equipment categories and accounts for job-specific insurance and bonding. For long-term projects, set up a work in progress account. Track your subcontractor expenses by trade category. All of this supports accurate job costing and accurate project type profitability analysis. Manufacturing businesses need 3 distinct inventory asset accounts raw materials, work in progress, and finished goods. Create detailed COGS accounts for direct materials, direct labor, and manufacturing overhead. Have specific accounts for production supplies, machine maintenance, and quality control. Track factory utilities and rent separately from administrative facilities, and set up detailed fixed asset accounts for production equipment and separate revenue accounts for product sales, repairs, and custom manufacturing. This supports manufacturing metrics like production efficiency and waste percentage, providing accurate data for product costing and pricing. Mapping legacy accounts. If you're transitioning to QuickBooks Online from another system, create a mapping document before importing. This should be a spreadsheet with columns for your old system's account names, types, balances, and the corresponding QBO accounts. Include notes explaining any consolidations or splits. This ensures no accounts are accidentally omitted and provides a reference for training staff on the new system. It also serves as documentation for your accountant or tax preparer. Review this mapping with stakeholders before implementation. When handling accounts that don't have direct equivalents, map the most appropriate account type in QBO. Plan to use classes, tags, or custom fields for additional detail. For example, individual vehicle expense accounts could consolidate to vehicle expenses with classes tracking expenses by vehicle. Consider whether tracking is actually necessary for business decisions, and create custom accounts when needed, following QBO's account type rules. Document special cases with clear explanations, and after migration, follow these account reconciliation procedures. Compare total debits and credits to ensure balance. Reconcile each balance sheet account against legacy system reports, paying special attention to AR and AP balances, and perform full bank reconciliation against statements. Run comparative reports between systems to verify the mapping. Document any discrepancies and resolutions. This is critical for ensuring accurate financial data in your new system. For historical transaction verification, follow this timeline. In the first month, focus on balance sheet accuracy and current transactions. During the first quarter, verify detailed historical transactions for the current fiscal year. By the 6-month mark, complete verification of all migrated transactions. Maintain your legacy system in a read-only mode for reference. Communicate this timeline to stakeholders and create a tracking document for verification progress and issues. This prevents feeling overwhelmed while ensuring data verification. What's the most confusing aspect of the chart of accounts in QuickBooks Online for you? Have you made any helpful chart of accounts changes that have improved your financial visibility? Share your experiences in the comments below. I'd love to hear from you. I'm offering a free 30-minute consultation to transform your chart of accounts. I'll review your current chart of accounts, identify any improvement opportunities, and show you the proper structure provides the financial visibility you need for better business decisions. The link is in the description below. Thanks for watching, and join us next week for customer and vendor management in QuickBooks Online.